Now that we've covered why commercial real estate is such a powerful investment vehicle, let's dive into how the real estate market moves in cycles. This is important because knowing where we are in the cycle can guide you on when to buy, sell, or hold on to properties. And understanding these cycles also shows you how to build equity and ultimately achieve significant capital gains over time. The real estate market follows a repeating cycle. There are 4 general phases: recovery, expansion, hypersupply, and recession. Each phase affects property values, rents, and investment strategies differently. For example, after a downturn, the market enters the recovery phase. Here, property values are typically low, and there's high vacancy from the previous cycle's crash. Investors who spot the recovery early can buy properties at discounted prices, setting themselves up for significant gains as the market improves. Next is the expansion phase. As the economy strengthens, demand for properties grows. Vacancy rates drop, rents start to rise, and property values increase. This phase is often marked by new construction as investors and developers anticipate future demand. Expansion is generally a great time to invest in real estate because rents and values are climbing, and there's strong demand. Next, we have hypersupply. This is when the market becomes saturated. With high demand, there's typically a construction boom, leading to an oversupply. This increased supply causes vacancy rates to rise again, and rent growth begins to slow. The market is near its peak in this phase, so smart investors begin to get cautious. It's often wise to hold back on major investments during hypersupply or start preparing for the next phase, recession. In the recession phase, vacancy rates climb, property values decline, and rents may drop. In this phase, the market is correcting itself as the oversupply created in hypersupply finally takes its toll. Savvy investors keep their eyes open here for discounted properties, recognizing that the next recovery phase is just around the corner. To better understand these cycles, let's look at some notable moments in U.S. real estate history. Some of you may recall the 1980s savings and loan crisis. During the 1980s, deregulation and easy credit led to a commercial real estate boom. Office spaces, hotels, and retail buildings sprung up everywhere. But this oversupply, combined with reckless lending, led to the savings and loan crisis in the late 1980s and early 1990s. Many commercial properties lost their value, leading to foreclosures and bankruptcies. Next, there was the housing bubble of the early 2000s. Following the early 2000s economic downturn, low interest rates and lax lending policies sparked another massive real estate boom. By 2005 to 2006, property values reached unsustainable heights. When the market finally corrected, we saw the largest recession since the Great Depression, with property values plummeting and foreclosures skyrocketing. After the Great Recession, the market eventually recovered, spurred by low inventory, low interest rates, and urbanization trends. Commercial real estate has seen steady growth since around 2012, although we continue to experience ups and downs due to economic factors, such as the recent COVID-19 pandemic, which impacted commercial spaces in ways that we're still navigating. Building equity in real estate is a matter of both time and strategy. Equity grows when the property's value increases, or as you pay down the mortgage, thereby increasing your ownership stake in the property. Here are a few ways to build that equity. Number 1, appreciation. Property values increase over time due to market demand, inflation, and improvements. For instance, if you buy a property during a downturn and the market enters expansion, the value of your property can appreciate significantly. Historically, commercial real estate has averaged a 2 to 3% appreciation annually, though this varies widely by location. Number 2, forced appreciation. In commercial real estate, value is often determined by the income it produces. By raising rents, improving management, or upgrading the property, you can boost its income and directly increase its market value. This is unique to commercial real estate, where the property's income, not just market trends, drives its worth. And number 3, loan amortization. As tenants pay rent, they're essentially paying down your mortgage. Over time, As you make payments, your equity grows. With the help of leverage, your tenants are effectively building your wealth as they pay off the property's debt. As we've seen, the market goes through phases, and these phases often correspond to either a buyer's or a seller's market. In a buyer's market, there's a surplus of properties, and prices are low. The buyer holds the power with the ability to negotiate better deals and secure properties at favorable terms. This typically occurs in the recession or early recovery phases when there are more properties than buyers. In a seller's market, there's high demand and limited supply, so sellers can command higher prices. Buyers compete for properties, and it's challenging to negotiate significant discounts. This usually happens in the expansion or early hypersupply phases, when the economy is strong and demand outpaces supply. For example, after the 2008 housing crisis, we were in a buyer's market as property prices were low, and there was an abundance of inventory. By 2015, however, the market had shifted and demand was high, creating a seller's market. Property values rose sharply, especially in major metropolitan areas. Understanding the real estate market cycle, building equity, and timing your entry and exit points are essential to maximizing your investment in commercial real estate. By buying during the buyer's market phases and selling or holding onto your properties during seller's markets, you can maximize both your cash flow and appreciation. Historically, those who understand these cycles and can anticipate shifts are the ones who build significant capital gains over time. Commercial real estate, unlike other investment options, gives you control to weather market shifts. With the right strategy, patience, and timing, you can build serious wealth and equity over time. It's not just about owning properties, it's about learning when and how to buy, hold, and sell to capture the full power of this asset class. If you play it right, the rewards can be truly transformative. All right, now that we have the full picture, let's discuss. Consider the time at which you're viewing this lesson. What phase of the market do you think we're currently in, and what opportunities or risks might that create? Leave your comments down below, and I'll see you in our next lesson.